Hello Sector Watchers, welcome to the show. This is the 202nd episode of Sector Spotlight for Monday the 10th of January 2024. It's a little bit of an odd day, usually I do it at the start of the week, but here we are, first episode of Sector Spotlight for this year. My name is Julius and I am presenting to you from Amsterdam in the Netherlands, and I sure hope you had a good start of the new year and you're ready for a new year full of asset class rotation, sector rotation, currency rotation, crypto rotation, everything rotation. Ladies and gentlemen, this is Sector Spotlight. Let's start with a good look at the current state of asset class rotation. We've got the two RRGs up on the screen, weekly on the left, daily on the right, with the asset classes that we're tracking here in Sector Spotlight. First thing that you immediately see is the disconnect between Bitcoin and the other asset classes. On the weekly, it's way to the right, it's inside leading, but it's losing some of its momentum. Still makes it the strongest asset, or if you want to use Bitcoin as a proxy for crypto, strongest asset class in this universe. Kind of the same when you go to the daily, where you see Bitcoin still far on the right, inside weakening and moving back to leading. So we know that that is a strong rotation. So Bitcoin versus the US dollar is went through a bit of a corrective move, but is now moving back up. So from a longer term perspective, Bitcoin still a very, very strong asset class. Let's take that off the charts here on both sides so we can actually get a little bit of a better handle of what's going on in the rest of the universe without the distortion of Bitcoin going on. And what we see then is interesting, because if we start on the weekly, we can see that a lot of these asset classes and long red tails moving into the lagging quadrant. That is weakness, that is suggesting relative weakness versus VBINX. As you know, VBINX is our balanced index benchmark with 60% stocks and 40% bonds. The only one that's moving up there, so there's also, by the way, the US dollar is also in there losing strength. Government bonds, high yields, and both commodity indexes, DJP and GSG, actually leading the pack on the downside. And then we've got corporate bonds, inside improving, rolling over, not the strongest. The only one that's really strong in here, and I need to blow this up, are stocks, that's SPY. It's the only asset class that is inside the leading quadrant and at a strong RRG heading between 0 and 90 degrees. So this image basically screams to you that stocks are the best asset class. Now, if we bring that to the daily version, it's a little bit more pronounced, but what we see here is weakness for corporate bonds, weakness for governments and high yields, weakness for both commodity tails that are inside improving and rolling over, and we see a little bit of a recovery for the US dollar going on. The question is whether that strength is enough to pull that tail of the US dollar on the weekly chart out of the doldrums and back up. I'm not too sure yet, because this is a long, strong move into the lagging quadrant, and this seems to be a little bit of a hiccup within that downtrend. But we'll look at the chart in a minute. More importantly is the fact that here also stocks are inside the leading quadrant and pushing further into it. So we've got on the weekly and on the daily RRG, we've got stocks as the only asset class moving into the leading quadrant, showing strength. And I do know that there's all kinds of stuff going on of a weak start of the year, and stocks are heading down, and I don't know, whatever the story is. But if I just take the facts and I look at the rotation of stocks versus the other asset classes, there is only one conclusion that I can draw, and that is that stocks are actually doing pretty good. Now, I don't do this too often, but if we bring in the monthly RRG, it becomes even more interesting. Because if you look at this one here, and let's again forget the strength of Bitcoin, but blow this one up, look at this. Also, SPY, stocks, the only one inside the leading quadrant and moving at a strong RRG heading, while all the other asset classes are pushing, further into the lagging quadrant. So let's, right at the start of the year, the only conclusion that I can draw from a current asset class rotation perspective is that stocks are still probably the preferred asset class. Now, one thing that you got to keep in mind, this is on a relative basis versus VBINX. So it is possible that everything goes down, so that VBINX goes down and all these asset classes go down, but that stocks are going down less than the other asset classes. That means that SPY will still show up inside the leading quadrant, but not necessarily go up in price. Is it feasible? Time will tell. We need to wait and see. But all in all, the conclusion should be that stocks at the start of the year are still in good shape, with SPY moving into the leading quadrant at a strong heading on the monthly, the weekly, and the daily RRGs. Now let's build on this premise and take a look at some of the individual charts here. We bring back that weekly RRG, so we've got our reference back. Bitcoin needs to go. Here you go, fit it, and then. So let's take a look at the US dollar. You can see here it is the US dollar index bouncing at support, bouncing off it. I prefer to look at the euro dollar chart, and here is the weekly version of that, and you can see the strength of the euro versus the US dollar. So that's dollar weakness, what you see here. Euro strength, dollar weakness. We had a little bit of a pullback here. That was strength for the dollar, but the overall trend is still moving higher. So the overall trend for euro dollar is higher. That means dollar weakness. And we could go all the way up to 111, 112. And if we go higher, that changes the picture quite significantly, I would say. We're not there yet, but the unbridled strength of the US dollar as we've seen it, especially in this period here from July, let's say Q3 of 2024, that seems to be over right now. If we zoom in on the daily version of that chart, you can see what I mean. We're in that rising channel and we just touched the upper boundary of that channel. We came down. It looks as if we're putting in a new low here and we are ready to move to the top of that trend channel, and then we'll have to wait and see what happens. So the strong move of the US dollar seems to has ended, and other currencies are taking over from the US dollar in terms of strength. We go to let's start with the commodity stuff. So here we've got DJP, and you can see how that is struggling to hold up above support levels. But what's worrying me is the relative weakness. We just pushed below the previous low here, indicating that there is more weakness ahead for DJP. And you will see a similar structure, a similar chart for GSG, which is also pushing in terms of relative strength below its previous low, and that's pushing the RRG lines lower. So commodities for the time being out of favor. And I don't see any strength coming in anytime soon, to be honest. I'm going to take off these. I'm going to take off the US dollar. Going to take off DJP, GSG, and then fit it again. And now we can see the stock bond rotation in more detail. And you can see that all three bond ETFs, bond asset classes, corporates, high yield, and government are at a negative heading and rotating either towards or already inside the lagging quadrant. And you can see how SPY is rotating into the leading quadrant, showing relative strength versus the bond markets. Let's do a quick look at, let me take a look at SPY versus IEF. That's the final conclusion on what you see on that RRG. And you can see that we are pushing to new highs here. And this is a weekly chart, so it's about 3 days into the move right now, but we're already pushing to new highs. It's a pretty strong signal. It just confirms the conclusion that we've already drawn from the RRG, that SPY is the preferred asset class in this entire universe. Let me go to take a look at SPY chart. So here's SPY versus VBINX. You can see the route strength here. The breakout above highs is holding up. We tested previous resistance as support. That is good. You can see how the RS ratio line came down for a little while, sort of digesting that relative move that we had, and it's bottoming out above 100, meaning that we had that rotation. That's what you see here, that rotation through weakening, and without hitting the lagging quadrant, SPY had already started to move up, is now pushing back into the leading quadrant. And that's what that green RS momentum line is doing. It went below 100, that's why SPY went into the weakening quadrant, and now it's pushing back above it and moving higher, indicating strength for SPY. And we're pushing against all-time high. We're very close to all-time high levels. I'm going to look at the outright weekly chart here. We're getting into a, let's call it a danger zone. I think 480 is a pretty serious resistance level, and I think it's a double resistance level because we got the resistance coming off that previous high, and that's more of a range between 475 and 480 probably. And then you can see the upper boundary of a kind of a rising channel. So you start with the so when you draw trend lines on an uptrend, you start with the support line, the rising support line, marking the lower boundary of that trend. We've got 3 touch points here, so it's a valid trend line. And then you just basically you plot the parallel of that line and you see where it fits. And here, lo and behold, we also have 3 touch points. We started with 2. You can do that because we had the parallel of that support line. So that resistance line, and that was now just touched upon a couple of weeks ago in that 475, 480 range. And we're now again testing that double resistance area. So now, a couple of things can happen. Let me first bring you the daily version of that chart. It gives you a little bit more detail. You can see how that is now pushing against that upper boundary there. But the weekly gives you that in it's probably a better picture to explain what I mean. We are in a long-term uptrend, that's for sure. We are now touching the upper boundary of this trend here, which lasts like 2023, it's probably the last year. If that resistance area works out, then it's very likely that the stock market SPY needs to take a breather. Not pushing above 480, starting to go sideways, maybe a little dip. If that happens, then we may see, and that's a big may see, prices going towards this area here, which is around 460. Let me go back to that daily chart, because there we can see the support around 467.5. If we break 467.5, so then we have set a peak somewhere here, we break 467.5, could even be a small double top-ish type of pattern. The target will then be in this range between 455, 460. So if that double resistance around 480 is too much to digest right now, S&P very likely to consolidate either sideways or a small dip with a potential target first around 467, 467.5, and then 455, 460 if that happens. If we take out, if the market is strong enough to take out that 480 level to the upside, means that the S&P is breaking to new all-time highs and we're kind of unleashing a spring that's been wound up, and we will very likely see an acceleration higher of stocks. And that would perfectly fit with the narrative of stocks being the preferred asset class right now. In both scenarios, that will remain the case. So it's either sideways dip, then break higher, or if it's really strong, break out higher and see an acceleration. I hope that I made myself clear and you understand the framework that I'm working with. It is both, in my opinion, still a pretty bullish scenario. Either you go straight away, or we get one more option to buy the dip before we move higher. That's how I look at the market right now. And from asset classes, we move over to sectors. We've got the weekly RRG on the left, daily on the right. And when you look at these RRGs, they look a bit confusing, because when you look closely, you will find that for a lot of sectors, the tails on the weekly are moving in one direction, and then on the daily they are moving in the opposite direction. So if you take a look here for XLRE, real estate, clearly moving to the right, inside leading, lost a bit of momentum. And when I find XLRE here, you see it's right on the opposite side, inside weakening, moving towards lagging. If we bring on technology, for example, so technology is right here, inside leading, short tail, lost a little bit of momentum. And when I look at the daily, it's inside the lagging quadrant, quite opposite direction. And that goes for quite a few of those sectors. And what that means is, I think, a sort of a message of confusion. Markets trying to find new direction. That's how I take this. Market, obviously we had a nice run at the end of last year, maybe the first few days of New Year, and then things started to stall a little bit. And that's what you see in this sector rotation. That market is trying to find a new direction. And as you know, I'm always looking for like offensive versus defensive type stuff. And if you look at the weekly tails for utilities, healthcare, and staples, then you will see that healthcare and utilities are inside improving and rolling over back towards lagging. That is definitely a weak rotation, and a weak rotation for defensive sectors is usually good news for the market as a whole, because that means that money has been taken out of defense and moved somewhere else. If you look at the healthcare sector, it's inside lagging, but it's just this week actually hooked back up, or the last week. So that is taking another turn. And if you then bring that up on the daily RRGs, you will see that staples, healthcare, and staples, healthcare, utilities, where's utilities? Right here, they're all at a strong rotation. So last week, the last 5 trading days I'm watching here, is definitely characterized by a rotation to defense. But we need to put that into a longer term perspective. And with the tails of utilities and staples inside improving and rolling over like they're doing here on the weekly, I think that the way we need to interpret these rotations for utilities and staples as being a intermediary, like a recovery move within the longer term downtrend. Now for healthcare, things look slightly different. We see that strength of healthcare is moving into the leading quadrant. The question is how strong that move will be. Will it be able to basically pull that XLV tail all the way back to leading? Or is this the start of a rotation for healthcare, going from lagging into improving, rolling over, and back to lagging? So a weak rotation for the healthcare sector. All in all, it's not all that important, because it's very clear that all these 3 defensive sectors are positioned on the left-hand side. They're still weak. Utilities and staples are definitely rotating back down. Healthcare seems to be picking up, but the tails on the daily, healthcare is now the strongest sector on the daily. When that starts to roll over, we'll have to see how that pans out here. For utilities and staples, when they start to roll over, they will get back in sync with utilities and staples on the weekly RRG, probably pushing them further down into the lagging quadrant. The fact that we're not like breaking to new highs is due, I think, to that small period of confusion that we're currently in. And what I'm looking for is sectors that are starting to get back in sync with their longer term tails. And the most important right now, we're already seeing a few of those. Obviously, we have healthcare that is doing that, so that is in an interesting position. And the other sector that is doing that is financials. So we've got financials rotating back into the leading quadrant, coming out of weakening, rotating back into the leading quadrant. And you will see the weekly tail of financials already inside the leading quadrant and moving to the top right. Now, just once more, I've explained this a lot of times already, but if you haven't heard it, be careful, because we're looking at a weekly RRG on a Wednesday after the market closed. That means that there are still 2 trading days to go before this weekly RRG is finished. And the last segment of a weekly tail is fluid until the Friday close. So on Friday, these are all Friday closes. So when the market closes on a Friday, that is the dot, and that will never change. From Monday open, you will see the new segment, but that last bit here can change as a result of the changing prices during the week. So you can't already draw the conclusion, because if I blow up this really far for financials, you see that it looks as if we got this little hump back down. It's perfectly possible that financials, if this move continues on the daily, will pick up a little bit more during the week, so on Thursday and Friday, bringing this end of the tail back at a positive heading. Just so you know that that is a possibility. All in all, financials still in good shape there, and the daily tail rotating back into the leading quadrant, getting back in sync. That goes for financials, and that goes for healthcare as well. Pretty much all the other sectors are in opposite directions and probably need a little bit more work in terms of price and relative before they get back into sync again. And obviously, a break of the S&P 500 above that 480 level, 4800 level, will certainly be helpful for that. Let's go over the individual charts of those sectors and see if we can bring them in line with what we see on the RRG. So we start with, I already did that, rank them on alphabet, so we'll find all these charts there together. Materials, trying to break higher, not really working. And you can see here materials, it's interesting, it's a very short tail on the left-hand side, exactly at 100 in terms of RS momentum. What that means is a very steady relative downtrend. Short tails mean steady, not much move, not much power, just steady. And on the left-hand side means a relative downtrend. And that is exactly what you see here. We're already in a series of lower highs and lower lows. We're just taking out a previous low here since, well, depends if you start here, then it's already in Feb 2022. If you're starting here, it's in July 2023. Despite the move higher, the relative strength for the materials sector is still disappointing. It's still in a downtrend, and you can see these RRG lines here. That's why it's such a short tail, because they're moving almost parallel, and that's what you see here. If we scroll through time, you can see how that tail is very short. So it lengthens when the move's got more power, and then it comes to a standstill and is just moving, continue to move relatively lower in a stable relative downtrend. That's what we call it. Let's go to communication services. Going through a bit of a correction, but you see here how that roll-out strength line still moving higher. The RRG lines went through a correction. The RS ratio is still above 100. And the green RS momentum line is below 100, but it's starting to pick up, and that's why that yellow tail here is starting to curl back up. And what we see here is that so far this week, XLC is trying to break to new highs. Let me zoom in slightly here. Oh, by the way, in case you haven't noticed yet, I'm using the new Sharp Charts workbench. just to get a look and feel of it and start using it in production in my shows. And one of the things I really love is that I can change a time frame and I don't have to click update. So it immediately changes when I do 5 and I say, okay, bring me 3 bars. It will immediately change that. I think it's a huge improvement. What we see is that so far this week, obviously there's still 2 more days to go, so we can't say that the close is above it, but it looks good so far this week. We're taking out, going to new highs, meaning that the upper boundary of the channel and the horizontal resistance around 77.50 comes within reach, and if that happens, that will certainly help the relative strength for communication services to improve further and move back towards the leading quadrant. Energy, probably the weakest sector in this universe at the moment. So if we look at that, the chart itself is not too bad, but if you look at the relative strength, it's just about to break to a new low. It's taking out support here after a long sideways move. RRG lines are pointing lower, pushing the XLE tail further into the lagging quadrant. So that is a sector, according to relative strength and RRG, that is better avoided. Financials, one of the stronger ones that I just mentioned already. So here is financials. And what I really like is the upward break out of that broad range. It's over a year worth of range, trading range. We measure, well, let's say this is between 30, 60, 31, so let's say around 31, and then the upper boundary is around 36, 37. That's about $6 that we can project on top of the breakout level. So that gives us 41, 42, 43, depending on where you start measuring, which is exactly the cluster of highs that we had at the end of 2021, start of 2022. That will certainly help relative strength. You can see that relative strength needs a bit of work to get back above this former falling support line. We broke that, we're now pushing against, it's acting as resistance, but when this continues, it will certainly bring it back into that falling channel when there is a lot of upside potential within that falling relative strength channel. And you can see how the RRG lines are pushing higher, and that will push XLF further into the leading quadrant. Industrials, XLI, nice breakout to new highs. This will now start to act as support. It looks as if today or this week is already happening, that we're putting in a new low. We're currently at the top of the range there. Relative strength is picking up. It needs still a little bit more work, so this is not very nice. We should get a new higher low here in order for these RRG lines to push higher. It's also still very close to the benchmark, so not a lot of alpha to be generated. But the break to new highs is definitely good news for the industrial sector. And then we've got technology leading the pack. You can see how that break caused a further rally. We had a little bit of a setback, and here also it looks as if we're putting in a new higher low, which is good news for the technology sector. Relative strength, you see this kind of sort of hovering over a new high being put into place. It's testing former resistance now as support, so that's good news from a relative perspective, and the RRG lines are following suit. We're seeing the aftermath of that sideways move creeping into the RS momentum line. That's the loss of momentum. Maybe we need to go through a rotation, leading, weakening, back into leading. But if you just look at the reading of the RS ratio level, XLK is the strongest sector in the universe, and that will not change anytime soon. So no matter what's happening, technology is probably going to be a very good sector for the next couple of weeks still. So here's staples. That's on the other side of the spectrum, where we see staples rolling over. And I mean, this is a very good example where you have an almost perfect uptrend within very narrow channel. You know, trends don't get much better than this. but relative strength is still slow. And what it means is that this trend is not strong enough to beat the S&P 500. The S&P 500 is going much faster, and that's why relative strength is going lower. And you can see how the RS momentum line is about to cross over back below 100, and that will push XLP into the lagging quadrant on the RRG. So not the brightest outlook for the consumer staples sector for the next couple of weeks. So here's real estate. Let's bring in real estate. That's a sector that's in transition. That has been a very weak sector for a long period of time, almost 2 years. And I think we're now at the first stages of relative strength where it's starting to bottom out. We've seen the first move, and you can see that right here after a very long, so here, this is where we crossed into the lagging quadrant. That's June 2022. It's a year and a half ago, 18 months of trend of underperforming XLRE. The price chart is improving. We're bouncing against resistance. We're in a resistance area, and you can see how relative strength is now slowing down a little bit. So the scenario that could unfold here is that price needs to take a little breather, and that will cause relative strength to slow down as well. And when price picks up and starts to break, you will see a pickup, and then you can see that turnaround of relative strength coming into full fruition. I'm not sure whether that can be done with XLRE continuing into the leading quadrant, or we need another rotation. But this is a sector that I will definitely keep an eye on when it comes down again in terms of price and relative, to look for new buying opportunities at lower levels in both relative strength and price. Utilities is kind of in the same boat as staples. We bring on the chart here, you can see a very nice uptrend, very narrow channel, but look at the relative strength. That is in a very clear downtrend. Again, this already started into lagging in November 2022, so that's also like a solid year and some months. From a relative perspective, there is very little to gain in the utility sector, and you can see on the price chart that there is a lot of overhead resistance waiting. So also in terms of price, I don't think this sector will start to fly anytime soon. And now we got healthcare. We already discussed the rotation of that one. Let's bring it up on the chart. You can see it's bringing to new highs. That is a good sign. So the price chart of XLV healthcare is actually doing really well. But we need a lot more in terms of relative strength to actually make this a leading sector. And healthcare being defensive and a overall positive outlook for the market in general, I'm kind of hesitant to see this sector to become one of the leaders in coming weeks. It's not a bad sector anymore. The break is definitely there. That's a good sign. But from a relative perspective, there's probably better sectors, better stocks to watch in coming weeks other than healthcare. And then finally, we've got the consumer discretionary sector. Nice push into the improving quadrant on that weekly RRG. Let's bring in the price chart of consumer discretionary. And there you will see that we pushed above the previous high. We dropped below. So we're kind of fighting with this. This is the reason why I try to avoid pointing resistance levels like in 2 digits, because it usually doesn't work like that. I think it's a range. So this high here is 172.40. You know, this is probably the area where you will find support. 170, 171, 175. 170 to 175. In that area, there's probably some support waiting for the consumer discretionary sector. You can see how relative strength is basically still sideways, but the RRG lines have detected an improvement. And if that continues, we can see XLY moving to the top of that broader range around 186, 187. That's my next target. If we can establish a new series of higher highs and higher lows, eventually take out that 187 area, that'll give XLY, consumer discretionary, a real good boost, and hopefully bring this relative strength once and for all out of that trading range and make a push higher, because this is a very important sector, very important growth sector, very important offensive sector that we need to do good to push the S&P higher in 2024. The tail on the RRG is actually looking pretty stable and pretty solid for the time being. So it's a good outlook for consumer discretionary in the next couple of weeks. And that's it again. This already wraps up the first episode of Sector Spotlight of the new year. Again, Sector Spotlight will continue to be available on demand on the Stock Charts YouTube channel, usually recorded and uploaded on Mondays. Feel free to share your thoughts and ideas in the comments below the video or use any of the social media handles on the screen right now. I hope you enjoyed the show. Looking forward to seeing you again next week at a new episode of Sector Spotlight.